to welcome PCA. Mr. Emkin, you want to introduce your team?
Mr. Chairman, members, Alan Emkin, PCA, thank you for the opportunity. We've been informed that there are time constraints. We will live within those constraints, and we look forward to answering any questions you might have. If you would please turn to page 2 of the book, I'll just get it started. First and foremost, if I didn't start off by thanking you for having had the privilege of working with you for 25 years in this capacity and another 5 in a prior capacity, I would be negligent. So thank you. It's been an honor and a privilege. Being here today, we want you to know that we're committed to provide all the resources necessary to meet the pension consulting needs of CalSTRS going forward. And we will not spare any effort to meet those needs.
I'm going to allow questions as they arise. So we have a question from Mr. Unnerman.
Hi. And you've actually spoken to these issues before, but one of the things we're trying to get people in their general presentations to be a little bit more directly substantive earlier. So as you make your initial presentation, I'd like you to address, one, the question that you're on the record on, which is in terms of our global equity allocations, where we should be passive, where we should be active, and to what extent. And then the second is, when we look at the non-equity correlated universe, what your point of view is there in terms of diversifying our risk, how you view questions of cost and illiquidity in that balance, and where you think that is appropriate.
Okay. Do you want to address that before I introduce the folks, or do you want? Okay. Let me just very quickly introduce the team. To my far right is Neil Rue, who's been with the company for over 20 years, is on the board of PCA, and will be a partner in PCA by the middle of next year. Judy Chambers has been with PCA for 6 years, is a member of the board, and will be an equity partner by the middle of next year. To my left is John Linder, who's been with the company for 4 years, and as a senior person has appeared before the board. And someone you probably haven't seen before is Colin Beebe. And he's the youngest person here, and I just want him to introduce himself, if for no other reason, have a great experience appearing before a board with $175 billion. And he just wants to let you know who he is.
Sure, there we go. I'm Colin Beebe. I've been with PCA for 4 years. I was actually hired essentially directly out of school, and been with PCA for that entire period. And PCA has been very supportive of both professional, educational, and my pursuits in other financial type designations as well. So it's an honor to have worked with PCA and with CalSTRS throughout that time period.
And all of us work on the account, and I want you to know these are the people who do the work in different capacities. Judy, why don't you just deal with, I'm trying to manage flow and answer the questions. So just deal with your page, and then we'll start dealing with the substance.
I think you all are familiar with PCA, given our long-term relationship with you and how much we value that relationship. We are a top 10 consulting firm. One thing that you've probably noticed over time is stability and consistency with the firm. We've primarily focused on public pension plans. We've had a very low attrition rate of individuals. Over 40% of our clients have been with the firm for over 10 years, and we're very proud of that fact.
The next page just shows the clients. Then there are pictures of us on page 7. No need to go into that. There's some lovely comments on page 8, which are relevant. But Neil, if you would just talk about page 9, and then let's go right into Mr. Unterman's questions.
Sure. Good afternoon. Pages 9, 10, and 11 essentially get to the culture and the philosophy that PCA has as a firm. The high-level point on page 9 is that we have striven very hard over since our founding not to have any conflicts whatsoever. Our business is strictly a fee-for-service contracting business, no discretionary business, no asset under management type of fee-related business. We're here strictly to serve our clients. Another thing that we do is our business model is to serve a limited number of very large clients. You saw the list that had about 30-plus clients on it. We don't want to expand that to 150 clients anytime soon so that we can customize our servicing for you and for our other clients. So it's sort of highlighted in that schematic below. Slide 11 or slide 10, we work with clients to help them form their investment beliefs. We better have our own investment beliefs as well. So those are laid out and go to some of the questions and we'll hit some of those philosophic points in a few minutes. But these are our investment beliefs in terms of a consulting firm. And then just on slide 11 goes to the schematic there, highlights the basic key functions that any investment consultant you would hire, general investment consultant you would retain, perform, asset allocation, strategic planning, i.e. blueprinting each class, developing, policy development, developing policies and procedures for the classes, i.e. the instructions, the operating instructions for the class, going out and retaining the expertise, either internally or externally, that's implementation, and then you got to monitor their program. And so one of our points with the presentation is you've sort of split these apart in terms of the category A and category B. We don't necessarily believe that's the best function for your overall general consultant because you might break the feedback loop that's associated with this servicing model. So with that, pass it back down.
Okay. With your permission, we'll go right to the questions. And I think it fits perfectly on page 10 because we raised some of those issues directly on page 10 of our presentation. First of all, liquidity. Liquidity, not just for CalSTRS, but for all of our large state fund clients, is a growing issue and requires more attention because most of our clients have net negative cash flow, and that net negative cash flow will be increasing and not decreasing, which requires that more planning and more attention be spent on meeting those liquidity needs so you don't pay short-term liabilities with long-term assets. And that is a component of pension planning that really has not been at the fore because really for almost 30 years, funds like yours did nothing but grow, as did the membership. Well, membership is either shrinking or flat, liabilities, payments are going out, a lot more attention needs to be paid to liquidity management. In terms of active-passive, we are a large supporter of passive management in sectors of the market that we believe are efficient. And that's most of the U.S. equity market. It's a big chunk of the non-dollar market. But we do believe there is the potential to add value in the less efficient parts of the market, which would be small stocks, particularly would be an area, and also in the bond market. In the corporate bond market, the potential to add value exists, and there are a number of managers who, in fact, have added value over the years. But the combination of lower fees, lower transaction costs, more predictability, we like indexation, and the larger the institution, the more that should be indexed. If you're currently domestically, I think it's 80-20. If you went higher than that, that would not cause us any pain at all.
70-30, they're 70-30.
70-30, then going to 80-20 or even more than that, we would not feel any pain at all. And a significant percentage of your international is indexed. Increasing that would also not be inconsistent with what we believe in. But just to be fair, we have clients that are heavily indexed. We also have clients that have no indexation. We have an opinion. It's you as policymakers who have to make that determination based upon input not just from us, but from your staff. Non-equity correlation. I'm not exactly sure what you mean with that question.
Well, we have a growing commitment to inflation hedge assets, real assets built into the asset and liability or the asset allocation plan is a nascent target on hedge funds. So you're thinking there as a way to mitigate both risk in the portfolio and generate alpha.
Okay. We have a strong opinion that real assets, which would include real estate, farmland, timber, energy, and inflation-sensitive assets, some of which would fall into that same category, have a real role in the portfolio. And most large institutional investors do not have a recollection of a period of inflation. In our opinion, we don't know when that's going to occur, but if you wait until it happens to start diversifying the portfolio, it's too late. And so we believe it's important to begin the process of getting exposure to those risk elements sooner than later. You've already got a real estate portfolio. You're beginning to develop an energy portfolio. You have some tips. There could be more tips. There's a potential for active management in that area, increasing or decreasing the exposure depending on pricing. But we believe there should be a healthy exposure and a well-diversified portfolio to assets which will hedge the portfolio's risk if and when inflation occurs. Almost every asset that's not an equity asset is going to have a lower expected rate of return than equities. And it's just important to keep that in mind, that as you diversify the portfolio, you do reduce volatility, but in all likelihood, you will be dampening expected return for the total portfolio over time. And that's not necessarily a bad thing, but it's something to keep in mind as you look at that issue. Neil, do you have any comments?
Is that answering your question? I would say what's interesting, if you look at like a generation's worth of investment activity, is that sometimes these classes in the past have been put in place with those exact same intentions, but then they morph into equity-related classes. So real estate is a classic example of that. There's a lot of leverage in the typical institutional real estate portfolio, in addition to pursuing more creative strategies in real estate. So it can end up having a higher correlation to public equities than we might have originally assumed when we put it back in place back in the late 80s or mid 90s. So those types, we have to be careful as we implement these new classes not to make that same institutional mistake again, but rather underwrite the classes in a better, more pure way going forward.
Do you have that commentary on that about hedge funds?
Yeah, I'll be the bringer of bad news. Before this board, we basically recommended that you not make a strategic allocation to hedge funds. We don't believe hedge funds are an asset class. Hedge funds are a style of investment structure that to charge fees, and you can be anything. Anything can be inside of a hedge fund. The only time I believe that it's worth paying 2 and 20 or something like that for publicly traded assets with no hurdle rate and no clawback is if you really believe you're going to truly get diversification. And so that would take a level of analysis that would say that this style of investment will really give us the kind of diversification we're looking for. And it's unclear to me that you can do that in enough size for an organization this large for it to have a meaningful impact.
Am I remembering incorrectly from our discussions in July, where I think we ended up tilting towards a target for growth in hedge funds? Investing?
No, the decision, my recollection in the
0%.
asset allocation was to take it away and to leave it as part of the innovation portfolio and not make a discrete allocation.
Is that it, Mr. Zuckerman?
Yeah. I mean, Alan, you have 2 minutes left in your part.
Before you go on, Ms. Hendricks?
This won't cut into your time, right? If I ask a question. I was just curious if you could comment, because it seems like 25 years working with CalSTRS is a real strength, but could you just comment, because there's obviously people who would say, you know, a long time with one firm might, you know, a different perspective, a different voice, and I just wonder how you would counter that argument. That's part one, and then part two is just if you could comment on a couple of areas that you're proud of in terms of contributions you've made to the growth of CalSTRS in the last few years, and maybe an area of growth moving forward.
As you have changed as an institution, so have we. We're not static. We are a totally different organization, in fact, with different leadership and a different board, in fact, different ideas than existed over that 25-year period. It's not a static organization, nor are you a static agency. In our opinion, the fact that we've worked together for 25 years is proof that we listen. And that doesn't mean we always agree, but it means that we listen and that we're responsive. And so for a very long period of time, we've been responsive. And there's nothing more important, in my opinion, in a relationship, particularly a consulting relationship to a large institution, than having consultants who listen. The accomplishment that I'm most proud of is that you're above where you were 5 years ago, that you have a great staff, you have a board that is completely unintimidated by the process of making hard decisions, and there's a lively debate on the issues. The amount of time that you spent on asset allocation is unprecedented. Now, some might say it was too much time, it was too painful, but you know what? When you're making that big of a decision, it should take a lot of time, it shouldn't be easy. We were challenged by more than one person on more than one issue, and it was a back and forth dialogue that resulted, in my opinion, in a very thoughtful and prudent decision. In terms of the accomplishments, the fact that we're still here, that we are still growing, and that we continue to meet with you and your staff and face challenges, that's a testament unto itself.
If we were to select you, what would be a growing edge or something you would want to kind of work on in the future, or an area that you want to develop?
There's one issue that you should be focusing on, and it's risk. And that's risk across the broad spectrum of issues. It's investment risk, it's funding risk, it's how to even measure risk and what kind of risks are more important to you than others. But the next 5 or 10 years, anyone who says they're not going to be challenging is living in a Pollyanna world. And you need to start thinking about how you function in a world where high single-digit, low-teen numbers aren't easy to get.
Alan, can I follow up on that quickly? Just roll forward to slide 21. And just to follow up on Sharon's question and Alan's answer is, I don't know if you folks have seen this information, but when the issue of risk came up post-crisis, a lot of dialogues occurring everywhere, and in particular between the consultants and your staff on how to deal with this issue and how to bring it in front of the investment committee. So we have been working very hard to create analytics that we can all use that make common sense. You're seeing a little bit of this in Chris's investment CIO report when he talks about the risk metrics, but that's only in a sense the tip of the iceberg. So there's all I wanted to highlight was there's a lot of information. This is just an example. You have it in your exhibits. There's some exhibits in this hard copy of the presentation that shows you some of the work that's going on in terms of risk management that probably more likely than not would eventually get integrated into your performance reporting that Alan does for you on a semi-annual basis. So you begin to look at these pictures and explicitly deal with them and have questions on what these trends mean going forward, which is a little bit different than just historical performance reporting. So I just want to highlight that there's a lot of work going on behind the scenes on this issue.
Mr. Utterman?
Thanks. Yeah, I wanted to follow up maybe a little bit deeper or on another perspective on Sharon's question. Can you talk about an example, specific type of guidance example, could be with us, could be with another client, where things really went well, created a lot of alpha, and one where things didn't go so well, and you learned a specific lesson?
Examples.
Okay, what page is that, Neil?
If you go back to slide 18, we have some examples. I'll just tee this up. We have different people that can talk on this. But there's a lot of things we're working on with CalSTRS. We just want to highlight with this slide that we're dealing with other state funds on similar large-scale issues with them as well. So I will stop there with the introduction comments, and maybe we can just tick through a few of these.
Sure. At New York Common, we're currently working with them on establishing their $8 billion opportunistic portfolio. And this is really to assist staff to analyze all the things that don't fit neatly into any other asset class, to take advantage of when there are market hiccups, such as after the global financial crisis. They didn't have any pools of capital to go after a lot of the really attractive things in the marketplace. So we have been working with them for over a year now on establishing that portfolio, and I think we've put about $1 billion to work to date on a portfolio that was just established in January.
How about the fixed income?
And yes, and we're helping them to restructure their overall fixed income platform.
John's going to address something that we did in 2010 for the state of Oregon.
Yeah, so I get to talk about some of the exciting and creative things that we've done with some of our other clients. The Oregon Public Employee Retirement Fund, we worked with them to bifurcate an opportunistic class. So they had this opportunistic class, and it was kind of a melange of different things. And effectively, we did an analysis that says you have a lot of different things going on in this class. There are things that you are doing here that are alternative risks, and there are things that you're doing in this class that are opportunistic. We think that you should divide those into separate classifications because one of them is taking advantage of an opportunity that may be a mispricing and should go away. And the other is more of an alternative risk that effectively you should be allocated towards on a long-term basis. And they incorporated that suggestion on our behalf and now have an opportunity class that has a zero strategic allocation that should only be filled up when effectively there is a good opportunity available. And they have an alternative beta class that is an allocation, a more standing or strategic allocation that allocates towards risks that are not equity risks, but are alternative risks, but are not necessarily private equity. You know that they are a big allocator to private equity. So that's an example of something that we did with one of our strategic relationships that is unique and different, and I think was quite successful. And then just recently we worked with them to work through a series of interviews with the investment council to develop investment beliefs that are explicit, so that effectively they can look at what they're doing as an organization and determine whether the way that they're invested is consistent with those explicit investment beliefs. Went through a process of interviewing one-on-one with the board members, the council members, and then went through a consensus building process to arrive at investment beliefs that will guide the organization towards making critical decisions that are in line with those expectations or those beliefs.
And one that didn't work, truly painful. We have a client that after the financial crisis did not want to take any more equity risk. A large part of their fund was in a savings plan. It wasn't in a pension plan. And they asked us what to do, and we said, reduce your equity exposure if you don't want the volatility. Reducing equity exposure for the last 4.5 years was a very expensive mistake. The challenge now is we think they've paid, in quote, the insurance premium. The key now is to be disciplined and live with that and not try to revisit it by throwing money back into the equity market. But that's a difficult choice, and we're discussing that. But out of everything that I've done in my career, that is without question the single most painful experience.
Thank you.
Mr. Rosensteel.
Thank you. So, sort of hard to figure out what to ask you since we work with you and we know you, and to ask you what you would do and sort of be repetitive of what we already know, what you're doing. But I wanted to follow up on Sharon's question, because I've got to believe that there's something that you think we could do better, or you could do better, or we could work together better, that things aren't, 100% ideal. So what is it, you've seen this board operate, you've worked with this board changes, but you've worked with, many of us for a number of years. We went through the asset allocation study. It was challenging, it was interesting, it was productive. But what can you do you think, to make us a better board? I mean, you're our consultants, you're not Chris's consultants. We have great investment staff, Chris and his people. We don't, arguably we could do fine without you or anybody else. So what is it that you're going to do for us to make us a better board, and what, if anything, different from what's been done the last 25 years?
In terms of changing what we do, in all due respect, I wouldn't change the way we work with this board one iota. I think we have a great relationship with the board. It's open, it's candid, and it's unvarnished. I don't pretty up comments no matter what it's about. It's just not, and a large part of the organization is me, particularly with this organization. You're my longest standing client, you're my biggest relationship, and you get priority. I wouldn't change any of that. In terms of making it better, I think the direction needs to shift much more to the whole issue of risk management and understanding, quantifying, and managing risk. We went through a very long period of constantly falling interest rates and rising equity valuations. Yes, there were some ups and downs, but it really paid to be a risk taker for 30 years. It may not pay as well to be a risk taker in the next period, and constantly revisiting that issue and challenging some of the basically generally accepted principles of what we do is going to be crucial. And one of those might be, if equity prices get up a heck of a lot higher, do you want to have wider bands? Do you want to have the ability to possibly reduce the equity exposure? Because that's 90% of your risk. And that discussion needs to be had. If you're going to have it, you should have it before the equity market peaks. If I knew when that was, I wouldn't tell you. I'd be using it for my own portfolio, but I don't know when that's going to occur. But will it occur? Yes, the equity markets are still cyclical. The reason they're high as they are today has very little to do with fundamentals and lots to do about monetary policy globally. At some point, that's going to change. And when it does, if you're not prepared to be somewhat reactive, in my opinion, you'll be very sorry about that later.
If we accept that we need to focus a lot more on risk, what in the next year should we be doing to deal with that? What should be the work plan, and what should we be doing with you and with your help with Chris and his staff about that?
It's first and foremost, it's taking a look at liquidity and really having a very, very detailed understanding of what your liquidity requirements are for at least the next 2 to 3 years, and making sure that there's adequate monies available to meet those liquidity requirements without having to sell long-term assets to meet short-term liabilities. That's number one. Number two is looking at the ranges around your strategic targets to see if you need more flexibility, if you want to grant either discretion or a methodology to come back to this board with ways to moderate the equity exposure in the total portfolio. And very importantly, it's to look at costs. One thing that you have influence over is costs. And most of those costs are in the private markets. And those costs are enormous. And attacking costs is always a good thing. There's never a time not to attack costs.
Mr. Lawson?
Thank you. This is a question that I believe I know the answer to, but given that this is being conducted in public session, I want to give you an opportunity to address it. The membership of this organization is very diverse. Senior executive staff is very diverse, and I commend our leadership for paying attention to it. Can you address the diversity of your organization as a whole, the team that would meet with us, that would service this board, and your commitment to diversity in the future?
Okay. 40% of our board is women. There are 5 people, there are 2 women. There are lots of women in senior positions in the company, and we have provided probably better maternity leave and more support for women who have families than I think any organization in our industry. We should and could and must have more minorities in the organization. We have 1 minority on the board. Judy's sitting to my left. But we need more. It's a challenge. To get really good people, it's a challenge. But the only way you're going to get it is if you try, and we're committed to doing that.
Mr. Utterman?
This may be an unfair question, given your long tenure here, but this is a split RFP. There are 2 roles, potentially. If the board went in the direction of 2 advisors, do you have a preference as to which slot you would prefer? And why do you think that would be more appropriate?
Well, first, I would be negligent if I didn't tell you I think that the division of responsibilities that was reflected in the RFP is probably inappropriate. Those 2 functions go hand in glove. We act as a secondary consultant for CalSTRS and for the state of Oregon, where we act as an independent third party, where they use 2 consultants, and that's a very clear role. But dividing the operational side and the planning side, in our opinion, isn't a good idea. Neil, you had some comments?
Well, I think to answer your question directly, if you forced us to pick, we'd probably pick the category A. But as Alan mentioned, the structures of those aren't the cleanest divides in our view. So we would, if you asked us how we would define category A and category B, probably if you go back to that schematic that showed the 5 functions, probably one you could break out that would be a most appropriate breakout is probably the performance reporting only. But just keep in mind that that's pretty seamless as it is already. State Street's already computing all your performance, and we're coming back and discussing that, but maybe you could have a separate monitor discuss that. But then the question is, what is monitoring, and does risk management, measurement, management, and all the risk issues that we're talking about to you at the table, is that the monitoring function or not? Because that's sort of, that's the performance monitoring isn't the big deal. Risk management's the big deal. And that's not even addressed necessarily all that tightly under category A or category B. So it's sort of like, well, we think that's monitoring, but what do what does the board think? What does STRS think? So that's sort of this notion of it might not be most effective to divide these categories up the way they are. But category A would be the one that if you force us to pick one, I think that's the one we'd want.
Okay.
Any other questions? Mr. Rosensteel?
So do you think category A would enable you to lead us through a risk discussion?
Well, I mean,
Address these issues?
it's challenging because the asset allocation piece is in category B.
Right, but asset allocation we do once every 3 years.
But the allocation piece reflects your policy, and as Alan mentioned, that's the dominant risk piece. Picking managers does not drive your overall policy risk to the degree that your policy portfolio does. It's dominant. So if you're going to risk manage and make it move, have it move the dial, you have to be having discussions about how you're going to proactively manage that policy going forward. That's where the risk is. So if you put that, all I'm saying is that if you have it over there in category B, it's a challenge to do what you're asking for if we just take category A.
I don't know how sharp the line would be in practice. I just don't know. I guess we haven't done this, and I don't know, how the contracts would be written or would have to be written. But I would hope that if we went with two firms, that we could address that issue, and if you were one of them, in whichever role it is, that you could work with us and the other consultant to do that. If you see that that's a real problem, I'd like to know that.
I don't think it's overwhelming, but I do believe that to the extent they do really overlap, then you've asked people to bid on something, and that's not reflected in anyone's bid. And what you really are asking us is, are we more than happy? Number one, we want to keep the relationship. So whether it's A or B or C or D is secondary to me. I want to continue to work for CalSTRS. But if you want our best thinking on all issues, you can't just draw a line in the sand. There's no clear division. And we would work with you and your staff to come up with a contract that allows us to give you our best advice and to work with another organization. I work with Wilshire. I used to work with SIS, and now it's going to be Callan at Oregon. We're used to being in an environment where there are multiple consultants, and I implore you to consider that. It's good to do it. It's just really important to define the roles so they complement each other, and you don't end up having ego battles between consultants, which I've seen happen, and it's not productive for any of the parties.
Having heard that, and I understand full well what you're saying, I'm a little puzzled by the selection of A versus B. If the great impact is really on asset, comes from asset allocation advice.
Well, if you look at the service components, I mean, we highlight them on a couple of slides here, but if you look at the service components on category A, they really involve blueprinting the classes. That's primarily so every single class, blueprints for every single class, as well as manager selection within every single class. So that's really sort of everything beyond asset allocation is there. And then there's the strategic allocation piece that sort of is left out of category A. But that's the big risk management, going to Mr. Rosenthal's question, that's the big risk management issue that's not in category A.
Yeah, that's the reason for my question.
Yeah.
And that's why when you asked me my opinion about dividing it up and where we would go, I was quite candid in saying we don't think that the way it's been structured is an optimal structure. We like multiple consultants. We think that can help add value. But in this case, the fit of those two mandates, in our opinion, is inconsistent.
Okay.
Mr. McGuire?
You may or may not be familiar with a recent Oxford University study that was critical of the value added by consultants to pension plans. How would you rebut some of the points made in that?
We wouldn't rebut the findings of it at all.
Did you bother to read it, Alan?
No. In fact, I had Colin do an analysis of it. And so I looked at it and I felt threatened because we got named as one of the big consulting firms. You wake up and when you look in the mirror, you don't think yourself a big consulting firm that should be in a Wall Street Journal or the New York Times. But there I was. And it wasn't something I was proud of, so we took a look at it. You know what? I don't think anyone can pick money managers. Right?
In that space.
In large domestic public equity, no one can do it. If there's any evidence anyone can do it, then that one consultant would have the whole world as clients, and then pretty soon they'd be another index fund. So we don't take exception. What we took exception was the way it was characterized. And the way it was characterized is that pension consultants don't add value. In that space, I agree with them. But in talking about risk management, in terms of asset allocation and cost control and all the other ways that we work with you and your staff, I think we had a lot of value. But, so what do I think about the study? I think the analysis was just fine. The interpretation for it for purposes of the media was really unfair to the whole industry.
Any other questions? Okay, seeing none, you've got 5 minutes for a close.
Well, it didn't go quite the way we thought it would, but that's okay. We really valued this relationship. We believe we've added value. We have never compromised our opinions or our thoughts. We want to continue the relationship and add value. We believe we have the ability to do that. We believe we bring a team of people that's uniquely qualified, that has proven their willingness to spend the time, the energy, and the resources to meet your consulting need. I don't believe there's another consulting team in the universe who would have committed the resources that we did to your asset allocation product. It was not just time and resources, but from our opinion, lots of money. But that's what you pay for. And we believe we can do that and continue to do that. It's easy to fly here from Burbank. I get here all the time. And we do business across the river. And just having that ability to say, hey, look, here's what's happening on one side of the street, and here's what's happening on the other side of the street. Here's what's happening at almost all of the large public pension plans in America, because that's who we work with. There's no other consulting firm you're going to talk to whose clients equal the list that we have and the tenure that they have. And first and foremost, thank you for the opportunity on behalf of all of us. It's been a privilege, and we really, really hope we have the opportunity to continue to work with you.
Thought that was going to be the close, but there is a question, Mr. Zeiger.
So once again, Alan, you've said something that's piqued my interest at the last minute. How did you think it was going to go? This is a genuine curiosity. I'm trying to see if we missed something that we should have been doing. Which is, of course, why we've been paid you all these years.
To my own detriment, I'm going to do this. I thought you'd focus on the ownership. I thought you'd focus on my age. I thought you'd focus on the fact that we do business on the other side of the river and that we have a lot of other large clients. And none of those issues came up. To your credit, or you've already discounted them either way. But we thought we'd walk through this because that's what usually happens in these meetings. And what you did is you forced us to think, so thank you for that opportunity.
We're trying to challenge you all the time.
Have you learned nothing from this board now? Now you know.
Okay. Thank you very much.
you.
Thank you.